these highs and lows that Michael just talked about, Drew, of stocks and earnings. From a macro perspective, it seems to be all about the Federal Reserve. But when I look at the equity market and I look at the bond market, it seems that they are writing two different screenplays. Which market do you think best reflects what the Fed is likely to do?
Well, I mean, I think the bond market's got what the Fed's going to do because they told the Fed what they wanted it to do, and the Fed just kind of, acquiesced, I guess is the nicest way of putting it.
The bond market will control the Fed, not the other way around.
Yeah, it seemed to be. If you look at all the data, you look at everything going on, you look at the U.S. consumer, you look at all the growth numbers, there's really no reason for the Fed to cut rates at the end of this month. But yet they're going to go ahead and do it.
You think they will? Because we had a guest on at the top of the show, Chris Campbell.
I saw him, and I appreciate his view because there's no good reason for the Fed to be cutting rates at this point. They put in a lot of effort to get rates where they are, and for them to turn around and just kind of hand over a rate cut because the markets are demanding it, I don't think makes a lot of sense.
But you still believe they will do it anyway?
Oh, yeah, they're definitely going to do it.
By the way, the Fed funds future is showing a, what, 100% chance?
I don't think we want to see what the market looks like if the Fed doesn't go ahead and deliver. So,
what does it look like? No, but I mean, paint that picture for us, Drew. It's not your prediction, but what would it look like?
Risk assets would do poorly in that environment. That's the nice way of saying that.
Stocks
Wouldn't be pretty.
Yeah, I'll say it. Stocks would sink.
Yeah, because they've been told that they're going to get something. Now, the funny thing is, if the Fed's telling you things are bad enough for them to have to cut interest rates, then why is anything doing well?
Well, we've asked that many times. I think it's an excellent question.
But I think the underlying thing that equities could be looking at is that the economy looks pretty good. Productivity is accelerating. Consumers doing well.
Retail sales were off the charts the other day.
Yeah, I mean something really good is happening, and the question is then do we need to add the icing to the cake, with a rate cut? I don't think. We do.
By the way, our RBI at the end of the show asks our viewers what they're seeing in their economy. You're going to want to hear it because it kind of plays into your thesis. That said, is there a downside to cutting rates? If low rates were just a net positive all the time, then just set rates at zero forever and disband the Fed and walk away.
Low rates hurt, and low rates have hurt, and low rates are one of the main reasons growth hasn't picked up. Low rates keep firms in business that shouldn't be in business. Low rates encourage savings rather than discourage savings at this point because baby boomers are moving towards retirement. They hold back wages. Low rates basically had been seen to be a panacea, and I think there's a growing body of evidence that suggests that low rates actually can cause more harm than good.
Well, we're going to get it, and I know you believe we're going to get a rate cut, and the market does as well.